And then, of course, as people join us, I'll let them in. So, again, my name is Imada Hercules. I am a financial professional. Just a little bit of background about myself. I have been doing taxes for well over 10 years. I am a licensed insurance agent. I help my clients with retirement planning, financial planning, budgeting, and pretty much just setting up their financial house. So today we're here to talk about, is your money working for you? And what does that mean to you? So just a few things to keep in mind as we go through the presentation today is, what about money is important to you? There was a reason when you received the invitation to come to the Zoom today, something spoke to you, right? Something kind of connected with whatever goals, maybe information or resources you're looking for when it comes to money. So I'm hoping that as we go through the presentation today, that you will be able to get some answers to your questions. You might walk away with more questions than you probably even started with, but at least it'll start a conversation. So as we go to the presentation again, why did you join us today? Let's keep that question in mind. You know, some people may want to learn how to save and grow their money. Maybe you joined because you have children and you're trying to figure out a good way to save for them for their future. Maybe you're trying to figure out how to protect your income for now or through retirement. You want to retire comfortably. You're looking to protect your family from maybe any unforeseen circumstances or setbacks that may come from financial loss, or maybe you have a business. I have a lot of clients who are small business owners, and you're looking for a way to protect your business as well as the income that you generate from that business. So just a few key points to keep in mind as we go through the talk today. So the first thing I want to start off with is the 3 rules of money. So we all use money. Every country uses money. Everybody uses money, right? But who really teaches us about money? You know, we don't really learn about it in school. We don't really learn how to manage our money, how to budget, and how money really operates. So I want to take us through a few things when it comes to money. The first rule of money is compound interest. Compound interest is definitely a topic and an idea that not too many people have heard of before. It's actually very interesting that Albert Einstein came up with this idea of compound interest. And pretty much you take the number 72 and you divide that by how much interest your account is earning. So whether it's a savings account, a checking account, or maybe a 401k account that you have, if it's earning an interest rate, which those accounts typically do, you take the number 72 and you divide it by that interest rate, and that will tell you how many years it will take for your money to double. So many accounts today, especially bank accounts, savings accounts, and checking accounts, only earn 1% interest, if even that much. Due to COVID and a lot of things that are going on with our economy right now, a lot of accounts are not even earning 1% interest. But for easy math, let's say your account is earning 1% right now. You take the number 72, if you divide that by 1% interest, the number 1, it will tell you that it's going to take 72 years for that money to double for you. Now, I don't know about any of you on the call today, but I know that I don't have 72 years waiting and hoping and praying for my money to double. I hope I have 72 years left in life, but I don't think I want to wait 72 years for my money to double. So one thing that we try to do, or that we want to do when it comes to saving our money, building our money up, is look for different accounts that can give us a higher interest rate, a higher rate of return. So in this first example, if you were to have an account that was earning, let's say, 4% interest, and you divided 72 by 4, you would see that it would take 18 years for your money to double. Now that sounds a lot better, of course, than 72 years, right? And then if you were able to find an account that was giving you 8% in interest, divide 72 by that. In the middle example, you can see that it would take 9 years for your money to double. So if you had an account today, your regular bank or savings accounts, and it has $10,000 in that account, in 9 years, you will have 20,000, in 18 years, 40, and so on and so forth. But if you were able to actually find some type of account or a financial resource that was able to give you 12% interest and divide that by 72, you'll be able to see that it would take 6 years for your money to double for you. So instead of having only $20,000 in 9 years, you can have $40,000. You can have $80,000 in 18 years as opposed to the $40,000 in 9 years. Your money would build up faster for you. So the difference between $10,000 at 4% versus $10,000 at 12% is literally a $600,000 difference, because your money is growing faster for you. Therefore, you're able to gain and build even quicker. So the second rule when it comes to money, of course, is taxes. As much as we may want to get away from taxes, there is no way getting away from that, right? So the first thing we like to talk about is tax now accounts. What is a tax now account? That's your regular checking, savings accounts that all of us have, right? It could be stocks or any type of CD accounts that you may have. And the reason why it's called tax now is because whatever money you have sitting in these accounts, they're earning interest, right? It might not be great interest, but they're earning something. But at the end of the year, you know, when it's time to file your taxes, you're going to get a document from the bank or whatever company holds these investments for you. And what happens? You have to file it on your taxes. So the $5 that you made on the account, or the $6,000 that you made on the account in interest, you're going to pay taxes on it. Then the other category you have when it comes to taxes is tax later accounts. Now, these are your retirement accounts that many of you may have with your employer. So you might have a 401k, maybe you have a 403b with your company. I know a lot of people still have pensions with their company, or maybe you set up a Roth IRA. The reason why they're called tax later accounts is because the money sits there, right? You have money going into it, maybe out of your paychecks, or you put money into it and you fund it on a consistent basis. The reason why they're called tax later is that when you're ready to take out the money, whether it's the principal or the interest that you have gained on this money, you're going to pay taxes on it. So if you have an account right now, let's say your 401k has $100,000 in it. That's great. But you know you can't touch that money until it's time for you to retire. So in order for you to touch that money, you have to be 59 and a half years old based off of current standards, right? When you are 59 and a half and you touch that money, you do a withdrawal, you're going to pay taxes on what you take out. Now, if you're young, you have a few years ahead of you, you're not ready to retire, you're not near 59 and a half, no worries, right? Think again, because we know what taxes look like now, but 10, 20, 30 years from now, we have no idea what taxes are going to be. Taxes, for one, never go down, they always go up. So there's the potential in the future that your money that you have right now saving in your retirement accounts at your jobs, your 401ks, your 403bs, or your pensions are going to be taxed maybe twice, 10 times, 20 times what they are taxed now. Again, we don't know what taxes are going to be in the future, but for sure, taxes never go down, they always go up. And a lot of the money that you have saved in these accounts could be withered down to literally half or nothing after you pay taxes on it. So the next category when it comes to taxes is tax advantage. Now, tax advantage accounts can be maybe a Roth IRA, They can be a 529 college savings plan, or they can be a cash value life insurance account. And the reason why these are called tax advantage is because when you do withdraw funds from these accounts, you do not pay taxes on them. When you decide to make a withdrawal from these accounts, it is tax-free. And the reason being is you're taking your current paychecks, you're taking the money that you've already paid taxes on, the money that your employer has probably already paid taxes on for you to fund these accounts. And these accounts are earning interest, just like your 401k or 403b, but when you do decide to take out the money, you do not pay taxes on it because you've already paid taxes maybe through your employer or through filing your personal income taxes. So that's why they're considered tax advantage. And in the long run, 10, 20, 30 years from now, this would definitely be advantageous to you in retirement or later on in life because you don't have to worry about how high the tax rate will be then. The third thing that we like to talk about when it comes to money are investment options. I know a lot of people are into the stock market now, definitely during COVID. A lot of people got into crypto and everything during COVID. So investment options are very important and they're talked about so much more now, but a lot of people don't know about investment options. So the first thing you have when it comes to investments are fixed investments. And the reason why they're considered fixed is because you have a guaranteed interest rate, and it's usually a low interest rate. So your fixed investment might only be earning 3% or 4%. Now, the reason why a lot of people tend to go with fixed investments is because of safety. You know that you're not going to lose any money in these types of investments because you have a guaranteed rate as low as it may be. The only issue with a fixed investment is that you limit your growth potential because you're only guaranteed whatever rate you sign off on in the beginning of that account. The next type of investment option is called a variable investment. And the reason why it is variable, just like the graph here, is because it goes ups and downs. It fluctuates with the market. Many of you might have noticed that in the past few months, the market has not been doing well. So a lot of people have lost a lot of money in their stock options, maybe in their 401k and 403 plans due to the market. So a lot of people like variable accounts or variable investment options because you can get a lot of growth potential out of it. If the markets are doing very good and it's up, 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 you have unlimited potential in growth and earning. But if the market is doing very bad and it's volatile, you can lose a considerable amount of money. So variable markets have a great potential for growth, but they do not provide you any safety options. The third type of investment you can do is an index account. And an index account is kind of a hybrid between fixed and variable. A lot of companies that offered index accounts have something called a floor, which is a minimum amount of interest you can earn on your account, similar to a fixed account. And a floor could be 0.75% in interest, 1% in interest, right? So you're guaranteed to at least make that. But what's also good about an index account is that you have potential for more growth. And the growth can be anywhere between 13 to 15%. With index accounts, you are part of the market. You're usually part of like an S&P 500. So when the S&P 500 is going up, your account is earning compound interest, you're getting growth. If the market goes down, but you have an index account, you do not go down with the market. Why? Because you have that floor. You have that guaranteed minimum that your account will always earn. So you're not losing any money. You're still actually earning money because you have a guaranteed amount that you are consistent to earn. So an index is, again, pretty much a hybrid between a fixed account and a variable account. So one of the things that I like to show here is how an index account can work for either children and adults, right? We want to see how our money can work for us. So this example is an illustration of a child who's 1 year old who has an index account that their parents saved and set up for them, right? The parents decided to save $300 a month in this index account for the child. Now, by age 21, highlighted in the green area, a 1 year old child at the age of 21 now has over $100,000 saved up in their index account due to compounding interest. This $111,000 that's highlighted here is tax-free money. This child, who's now an adult at age 21, can now take out $111,000 tax-free to pay for college, to go to trade school, to travel the world if they wanted to, without any repercussions or complications because they have tax-free money. There is no minimum requirement that this person had to be 59 and a half to take out money. There's no issues with having to pay taxes because it was already post-tax dollars that were saved in this account by their parents. And after years and years of saving, they were able to save over 100 and something thousand. But here, this person decided to only take out $40,000 out of money. They didn't want to use the entire $100,000 that they had saved up. And they were able to take out 2 withdrawals. So they took out $80,000. Now, what's good with an index account, if you don't take out all the money that's left in the account, whatever stays back will still continue to earn compound interest. So if you use a little portion of it to take care of whatever financial needs you may have, whatever stays back in the account will still continue to grow and work for you. And you can continue to withdraw the funds as needed or let everything stay back there and accumulate for you. Now, the same child that started off this account had the account up until age 69. At age 69, from saving from a child, they were able to save $1.6 million inside of this account. And let me reiterate that. Because the parents opened up this account for the child and only saved $300 a month for them, this adult now has over $1.6 million available to use now for retirement. Now, tax-free retirement, right? Because this is already post-tax dollars. They're at retirement age. They don't have to worry about paying taxes anymore. So as an adult in retirement age, they are taking out now $80,000 annually to live off of. And because there's so much money still left back in the account, it's still gaining interest. So they're able to take out $80,000 for about the next 8 years to live off of annually while still having money left in their account, still earning interest. Now, here's an example of someone that's probably closer to our age. This is a 30-year-old adult who decides to save $600 a month in their plan. So when Jenny, who's 30, reaches age 65 down here at the bottom end of your screen, she's able to have saved $787,000. Now, I don't know about you, but a lot of adults that I know do not even have nearly that much saved up for their retirement future, right? So saved up over $700,000, which is great because of compound interest. So now that Jenny's in retirement, she decides to take out $48,000 annually as her retirement income, leaving still a lot of money left back in the account to do what? Still earn compound interest. And Jenny is able to do that for pretty much the next 20 years, having a steady income and still gaining compounded interest because she did not touch all of the money that was left back in the account, and now she has a tax-free retirement future. This next example is of a 50-year-old female who decided to start an account. And that's the thing, you know, you may have accounts now, you may not have anything saved for retirement. So it doesn't matter if you start early in life as a small child or you start later off in life as a grown adult. The point of the matter is that you start at some point saving and saving your money in the right type of options for you. So this is a 50-year-old female who decided to start saving. She saves $600 a month in her index account. She was able to save $220,000 by age 70. So she waited a little bit longer, probably worked a little bit longer because, you know, maybe she didn't have enough money, maybe she didn't have enough years. So she waited a little bit longer to retire, which is totally fine. But now that she did that and she has a good cushion set up, she chooses to take out $14,000 annually as her income. And she's able to do so again for the next 15 to 20 years. And that's the point, that you're able to start saving when you can. And as you do so, the longer you let your money sit and grow for you with the compounded interest, you're able to generate way more income that's tax-free for later on in life. Now let's talk about things from a different perspective, because I know a lot of people have 401ks, 403bs, and pension plans with their current employers. So your retirement plans are funded by pre-tax dollars. And what I mean by pre-tax dollars, your job takes the money out of your paycheck and sends it to whatever company is holding your retirement plan. The money hasn't gone through the whole taxation system, right? It hasn't gone to the federal, the state, all the other places that it has to go. So it's pre-tax dollars. Now, of course, the good thing about our retirement plans is tax deferred growth. So it's sitting there for us, it's in the market, it's growing. We're not thinking about the taxes on it. We don't have to worry about it. We're just hoping that it actually grows as it sits there. So you get good stock market returns, of course, like I mentioned in the beginning, if the market is going up. But if the market goes down, these plans are susceptible to a volatile market. And in the past few months, I know several people who have lost anywhere between $40,000 to $70,000 in their retirement plans because of how poorly the market has been doing right now. These plans, they're taxed as ordinary income. So when you do reach 59 and a half, you will continue to be paying taxes on this money now. A lot of the times, if you take out the money out of your retirement plans before you reach age 59 and a half, what do you have to do? Pay an additional penalty. So I've already been working 20, 30, 40 years, been saving in all of my retirement plans, just to finally reach retirement age, 59 and a half. Now I have to pay taxes, right? What if I want to retire early? I'm done working. Maybe I'm 55 and I'm like, you know what? I want to live my best life now. I'm done working. I'm going to have to pay not only regular taxes on that money, but I'm also going to have to pay an additional 10% on taxes on my own hardworking money that I've saved all these years. Now, the kicker, of course, to all of this that a lot of people may not know is that if you do not take out the money out of your retirement plans, by the time you're age 72, the government kind of makes you take out your money. They require you to take out your money by age 72. With these types of plans, a lot of the times you have no real type of coverage. You don't have life insurance. You don't get any type of coverage when it comes to long-term care. If you become sick or ill, there's no coverage or any benefits to help you with those expenses. It's pretty much what's in there is all you have to work with. And honestly, what's in there you may not be able to work with because half of it is probably going to go to taxes. Now, with an index account, it's after-tax dollars, right? It's post-tax dollars. So with an index account, because you already paid taxes on it through the year, you don't have to worry about the money that grows in there. You're still getting your tax-deferred growth. You're still getting stock market returns, right? Because it is in the S&P 500, but you're not getting the volatility of the market. You have no losses because you have a guaranteed floor. You have a minimum that you are going to be guaranteed that you will always earn. Like I said, whether it's 0% or 0.75%, you will always be earning something. You get tax-free withdrawals. So you don't have to worry about when you are 55 or 59 and a half or 72 about still paying taxes. You don't get an extra 10% penalty because you want to touch your own money. You can take loans out of your index account. There's no age requirement for access. The government is not saying you need to use this money by the time you're age 72. And an added benefit with index accounts is that you get life insurance. You know, a lot of people always tell me, you know, Imara, I have life insurance with my job. I've been there for X amount of years. And I'm like, that's great, right? But the kicker, again, to all of this is, if you get laid off, if you get furloughed, and when you retire from your job, a lot of times you cannot take that insurance coverage with you. And a lot of people do not know that. And a lot of people do not understand that. You are working with your employer, so that's an added bonus. That's an advantage that they give you. But if you are no longer there, whatever type of insurance coverage you have with them, you usually cannot take with you. So let's say you've been working with your employer for 20, 30 years. You're now 55, 65, you're looking to retire, but you're not as healthy as you used to be 30 years ago, right? But you still want life insurance. Maybe you have kids, maybe you have grandkids, maybe you have assets, a small business. So you still want some type of coverage. Now that you are older and may have some type of health issues or complications, it's going to be way more expensive for you to get life insurance, as opposed to you having a separate personal policy from your employer when you were there 20, 30 years ago. So people always tell me, Imara, yeah, I got life insurance with my employer. Yes, I have this with my job. If COVID has taught us anything, nothing is permanent. Jobs come and go. So you need to have other resources and tools in place to protect you, your money, and your family outside of your job. Some other added benefits when it comes to index accounts is that you do get long-term care, which is, God forbid, you get older or you're unable to complete some of life's daily activities, like you need assistance for someone to go to the supermarket for you. Maybe you need a home attendant to help you around the house, to help you bathe, to cook meals for you. Some of these accounts can give you long-term care, which helps you pay for those resources and additional assistance you may need later on in life. Index accounts come with a tax-free death benefit. So if you have beneficiaries, maybe a spouse, maybe children, even grandchildren, God forbid something happens to you, they will be able to get this money tax-free. So again, some things about the policy that I had mentioned is that guarantee of safety when it comes to index accounts. You're always going to have that minimum, either 0.75% or 0%, depending on who owns the account, right? You're going to get growth. The growth is usually capped off at 15%. And, while a lot of people may be like, wow, that's great, it is great. It's 15%. Yes, with the variable investments, you can get up to 100%, but you can also lose 100% in variable investments. So again, you get tax advantage, tax-free access to your money that you worked hard for and saved for years. You don't have to worry about paying taxes when you take out the money. You can take loans on the money that you have in there, just like you can with your 401ks and 403bs, but you don't have to worry about any additional penalties and losing any more money. And the protection and the benefits that you get with this, when you can have, let's say, long-term care, if you suffer from a critical illness or terminal illness, and the way that you can utilize the money that is saved in here is definitely unprecedented. So if you can see the screen, and let me just minimize this a little bit. Here is an idea of what savings could look like for you. So let's say if on average your index account was earning 8% in interest. If you're saving $200 a month right now, in 10 years you can have around $36,000. In 20 years, over 100,000. And if you're young enough and still around, in 30 years, almost 300,000. And this is at an average of 8%. Remember, you still have the cap of 15%. So you do have the possibility to earn way more than this on your investment. If you were saving, let's say, $500 a month, maybe you're a little bit older, or maybe you have a little bit more income, discretionary income to save, right? You want to build up cash value a little bit faster. In 10 years, you'll already have $90,000 saved up. Again, most Americans do not even have $90,000 currently saved up in their 401ks or 403b plans, and they've been working at jobs for 20, 30 years. In 20 years, you could have almost $300,000 saved up. And then, in 30 years, pretty much almost $800,000 saved up to live off of tax-free for retirement. Now, some people that I get when they ask me, how about doing a lump sum? Maybe I don't want to do the occasional, $200 every month. Maybe I have, $10,000 already sitting in a savings account and it's not really earning any interest for me. Can I open up an index account with that money? Of course you can. And if you wanted to do a lump sum option, in 10 years, you already have $22,000 saved up. Your money's already doubled for you. And I'm sure if you had that money still sitting in your savings account, it would not have reached $22,000. The money is not going to double that fast for you. In 10 years, some people don't even have $22,000 saved up in their 401ks and 403bs. If you were able to save $25,000 as a lump sum, in 30 years, you can have almost $300,000 saved up tax-free to use at your discretion. So again, everything starts off with a plan. A lot of people, they come to me and they're like, I wish I knew what I knew now. I would have started when I was way younger. I would have did this. I would have did that. Yes, we know. Shoulda, coulda, woulda. Never think about the past. Let's focus on today. Start making a plan today. Start saving today. Let's move forward and look better for a brighter future financially. So why is financial planning so important? And why is working with someone like myself so important? Because a lot of the times you may not know where to start. You know, talking about money, thinking about money can be very overwhelming. You may feel lost in the whole plot of planning your financial future, and you need a roadmap. Maybe you need tips, maybe you need a guidance just on where to start, where to begin. You just don't want to deal with it. I'm the type of person sometimes I just don't want to deal with it. My car, I can fix a flat tire, I can change my oil, but I personally just don't want to deal with it. So I take it to the mechanic. I can do it, but I'd rather have someone else do it for me. So sometimes doing it yourself is a good idea, but sometimes you might want a professional to take care of it for you as well. You like managing your money, but you may realize that your financial plan may need another set of eyes. Is it realistic? Are you really outlining your goals? Are your goals realistic? And is the plan that you've put in place going to help you reach those goals? So having an impartial party, having someone else look at it for you can help put you on the right path. So let's talk about taking the next steps towards financial independence. It all starts with getting organized, you know? Do you have a budget? Do you know what your monthly expenses look like? Are you spending more than you're actually bringing into your household? So you want to have an idea of what your financial house really looks like right now. You want to be able to track your expenses, or at least know and understand where your money is going. You might want a professional support team, so you'll enlist someone like me, or you'll get someone else to help you to guide you along that route. You know, you may want to build a budget and a financial plan with an advisor and then do it yourself moving forward. You might look into paying off debts first before you start saving. Again, I spoke about budget creation. Everybody needs a budget. It's so important to know where the money is going. So this is another presentation that I'm hosting this month on June 22nd. Is your business making sense or sense? This is more for my small business owners or people who are looking to open up businesses. I do get a lot of questions on how to register a business, how to record and track business expenses, payroll, and how to also start building business credit. So on June 22nd, this is another Zoom that I would be hosting, just trying to give some ideas and pointers on how to get this up and running. And here's my contact information. If anyone wants to get a hold of me, I'll leave this up here.